thank Howard and his team because together we were able to put this program together, and not only figuring out what the curriculum is, but promoting it and hosting it, working with 1871 to get Wall Street Journal to be the educational series sponsor, really shows how we can move the ecosystem. So thank you very much, Howard, to you. I'm in that position, kind of like when you have a drink in your hand, you can't really clap with a mic in your hand either. So if any of you ever had that problem. So with that, I also wanted to thank the HBA management team and staff. Michael in the back that's taking pictures, if you could raise your hand, he's the Associate Director of Hyde Park Angels. Alita is the Associate Manager with Hyde Park Angels. She coordinates all of our programming, community outreach. I wanted to thank Jenny, Amuth, and Forrest who helped coordinate this event too, so thank you very much. So that gives you a little bit of idea of who that team was in 1871. My name is Peter Wilkins. I'm the Managing Director of Hyde Park Angels. I want to welcome you as entrepreneurs and guests of entrepreneurs for coming to this event. And I also wanted to welcome, I know that we're live streaming this via webcast. We have folks in Cincinnati. Centrifuge is participating with the coordination of Alita and team, as well as TechPoint Indy. So we've been really trying to reach out to not only connect with entrepreneurs in Chicago, but in the Midwest. With that, when we look at the things that we're trying to do, many people don't know who Hyde Park Angels is. And so to give you kind of a general sense of who is Hyde Park Angels, think of it this way. We have 100-some members, and those members have been successful. Maybe they started their own business. Maybe they're successful executives or high net worth individuals. And what they decided they wanted to do is make a difference in the Midwest and in Chicago. And the way they decided they could make the biggest difference is to give back. To give back both with their human capital and their financial capital. And so what they do is they look for entrepreneurs where they can invest their expertise, their time, and their capital to help them drive successful business. And what we feel is that if we're successful in doing that, then we're going to have successful companies, which creates a successful community, and we really create something that becomes an ecosystem not only in Chicago but in the Midwest. So our focus has been around that. One of the things that you may notice that we handed out, just to give you a sense of where we play in the market, is we have a sheet that shows that we've had some success. We're the #1 angel group in the Midwest. We have invested in over 30 companies. We have 31 portfolio companies. Had over 150 million of capital collectively invested in those companies. We have generated over 500 jobs and generated 25 million in revenue. In this last quarter, we've been active. We had done 13 deals, 4 new portcos. So we've recently added Geophedia, Packback, Public Good Software, and Turbo Appeal. But one of the things that we know is that we can't invest in every company and every entrepreneur that we meet with. We only meet with hundreds, and we only invest in about 1%, maybe even less than 1%. So the members and the group said, how do we give back to the community and really help those entrepreneurs navigate to ensure they're successful? And that's why we came up with the entrepreneurial series. So many of you may have received this booklet. The idea is to provide a framework of how to navigate early stage investing so that you can make better decisions. And so this program is not only available in the live events, but we provide at HydeParkAngels.com monthly newsletter, a weekly blog, which is also, you can follow us on Medium. And it allows you to really navigate that path to figure out how you can be successful. So not only do we want to be able to use our expertise to help invest, but we also want to give to those entrepreneurs that we might not invest in. And I think that in that, we also realize that we need support in doing that. And what we've been trying to do is partner with folks that are building the ecosystem. So you have a resource guide, and these are our partners, but they're also core organizations within Chicago that is helping Hyde Park Angels build the entrepreneurial ecosystem. So within that, you'll see, and I know that we have First Analysis. Could you raise your hand for those that are here? Great. And I know that the other folks that are a part of this program, that their focus is on corporate venturing and corporate innovation. So they come to the ecosystem and help support our portfolio companies and future companies in that way. And then in addition, we have resources that we're working with our corporate sponsors, and what they're doing is they're working with our portfolio companies and emerging entrepreneurs to provide them domain expertise in the various categories, from accounting to legal, etc. And our view is that if we work with them, or our portfolio companies have worked with them, we vetted them, and it allows us to give you an opportunity of some folks that you might want to work with. I see Bailey from Wintrust. Bailey. Let's see a shout out for some of the other of our sponsors that are here. Alita, can you give me a quick, those that are here, do you have a quick count? Andrea? From Rago. In the back, great. Stacy and Cara from Lane. Stacy and Cara from Lane Financial, thank you very much. Great. So this is, in all fronts, what we're trying to do and give you a sense of Hyde Park Angels is not only are we an angel group, but we're trying to create an ecosystem that's stronger, and so we developed our educational programming, and we're trying to provide resources. So enough about Hyde Park Angels and what 1871, what we've worked to build today. We're going to get into the panel, which is why everybody's here. So first thing I want to do is I want to at least recognize the Hyde Park Angel members. Those that are members, if you could raise your hand. Great, a round of applause for you. Now the meat of the matter. How many people here are entrepreneurs or aspiring entrepreneurs? Awesome, so we got a good mix. All those on the webcast, how many? Awesome. How many of you that are entrepreneurs know how to write a term sheet, or what's important? All right, so you guys are in the right place, and that's what our expert panel is going to talk about tonight. So I'm going to hand it off to Ira, and we're going to do a round of introductions, and then I'll start the panel discussion.
Great, thank you very much, Pete. Do people hear me okay? Yeah. Oh. Press the button. I'm Ira Weiss. I'm a partner at Hyde Park Venture Partners, and I also teach at the University of Chicago Business School, private equity and venture capital classes. I've been doing startup investing for about 15 years, first on the side of being a professor, and then decided I love working with startups so much that now I work with startups full time. Hyde Park Venture Partners is a Chicago-based venture fund that invests throughout the Midwest, mostly in tech-enabled business and consumer services. We typically get involved when a company's doing somewhere between $250,000 a year in revenue up to about $2 million a year in revenue. So if you have a company and would like to talk to us, please do.
I'm Such Chitnis. I am a partner at Jump Capital. Jump is relatively a new venture firm. We started it about 3 years ago. We're a multi-stage firm that invests between $500,000 to $15 million first checks, and primarily focused on expansion stage. And the team is made up of people like myself that are reformed operators, people that have run companies wanting to some extent give back, but give a different lens towards investing. So we focus on healthcare, enterprise, advertising, marketing technology, financial services, and essentially anything with the term big data or deep data. We tend to focus on expansion stage, which is typically $2 million and above, and I'm sure we'll get into the different size types of rounds that are out there, but we tend to be a pretty active investor. We have 27 investments in our portfolio.
Hi everyone, my name is Ashish Dalal. I'm the founder and CEO of Heartwiz. Heartwiz is an app that can help you find and book your parking spot ahead of time. You simply go to you can download our app if you guys have your phones today. You can download it on iOS or Android device. You simply tell us where you're going, and we'll show you all the parking at or near your destination. You can save up to 50% using our app. I know some of you who are in Chicago might be familiar with some other local competitors. One of the ways in which we differentiate from sort of competition and just really provide a value to consumers is one, we have a nationwide breadth of footprint. So anywhere you're going, whether it's Chicago, New York, LA, we have coverage across the country, over 3,000 facilities. Here in Chicago, we actually recently introduced a program called Simple Price Parking. It's what we call sort of the 5, 10, 15 program. You can download our app. It's only available on the app, but locations where for the first hour, you only pay $5, up to 2 hours, for 2 hours, $10, and for 12 hours, you'll pay never more than $15. So consumers so far, we launched it only about a month ago, and so far, consumers have really responded. So I'm really humbled to be on this panel. To date, we've raised about $12.5 million of funding, so I have some, but not all answers, and really just excited to see what else everyone else has said, so thanks.
Full disclosure, we're investors in Heartwiz, as is John.
Yeah, so it's a little bit interesting, because I have 2 of my board members here, so I might have to draw a wall at some point, some of the questions. But.
Full disclosure, they did not invest in me, so I'll have a different perspective. I'm Desiree Vargas-Wrigley. I'm one of the founders of Give Forward, and we are a platform that specializes in crowd giving. We give people an answer to the question, what can I do to help when a loved one is going through something difficult, like a medical diagnosis or the loss of a loved one or a home fire. And to date, we've helped people raise over $165 million, and we make our revenue by taking a percentage of transactions. Oh, and sorry, to date we've raised about $7 million, and we've done angel, seed, Series A, venture debt, and strategic. So I have a lot of different perspectives to bring.
Hi everybody, Rishi Shah. First off, welcome. This is awesome that there's so many people here on a Wednesday evening on this topic. So I'm blown away. Very cool. I run a fast-growing health information company that works with health systems and medical groups across the country to help them serve information to their patients in contextual and targeted ways at the point of care. So think the video monitors in waiting areas, in doctor's offices, tablets in the exam rooms, soon digital wallboards and content embedded into electronic health records as well. We didn't raise any capital for that business. I did try, and I failed when I was 19 and dropping out of college, so we can talk about that. We ended up bootstrapping a unicorn, I guess, so it worked out okay, but it took a while. And then 3 years ago, we started a personal venture firm, just direct investing into startups out of our family office that Shraddha and I, my co-founder, do together, along with a few of our colleagues. We've made 42 investments. Generally, we'll invest $10,000 to $250,000 up front, and then we'll very selectively, aggressively invest in follow-ons. And a few of those have included BucketFeed, SwipeSense, Syndio, amongst others.
Excellent. So for the group, the selection of the panelists will really give you an opportunity to see investment, early stage investment from a lot of different lenses. And a couple of the panelists can wear a couple of different hats, so I think those should provide really interesting answers, as well as a great opportunity for you to ask questions at the end of the session. For those of you that are online, you can also send me a Twitter question at Peter_Wilkins, and I will try to answer one or two at the Q&A portion of our session. So to frame it up, because I often sit in seats like you, and I often think, what are they going to talk about? And then people just start talking. So I'm going to help put it into segments. We're going to first hopefully give you the foundation of what is early stage investing, kind of what are the different steps. The next segment we're going to talk about is why would you want to raise capital? So it's going to be high level because we only have an hour or so to go through this panel. And then the next element will be around terms. What do you look at from a term sheet, cap structure, etc. And then we're going to finalize how do you find the right partner. Now clearly we can't hit that in depth, but those are key elements as you're kind of navigating this cycle that I would make sure that you're paying attention to. So wish us luck. We will commence our journey in helping you navigate early stage investment. With that, Ira, being a professor, you should be able to really set the foundation and give us an idea what are the early stage cycles that a startup may go through.
So early stage funding cycles.
Thank you. Forgot some words, but you'll fill them in. We're a good team.
I'm a professor. I tend to kind of lecture people, unfortunately. So I've made about 120 startup investments over the last 15 years. The typical, so we can talk later about kind of when and whether to raise money. If you end up raising some money, we will often see people maybe raising some money from friends and family initially. The first stage that is a little bit more formal stage, we would call the seed stage. That could be in the Midwest, it could be around that is $750,000 up to $1.25 million. It comes in a couple different forms. It could be equity, preferred equity, or it could be a convertible note. I'm sure we'll talk more about that later tonight. After that round, we would see a Series A. Usually in the Midwest, that is maybe $2 million to $4 million in terms of what you end up raising. If you were on the West Coast, that would probably be $8 to $10 million. So there's a pretty big difference between what gets raised out there and what gets raised here in the Midwest. Then you get to Series B, which actually at some point I'll hand over to Jump, because our group tends to invest at the seed stage and the Series A stage. So maybe I'll actually hand that part over to Such.
Yeah, sure. So Series B for us and for a lot of what we see in the Midwest is typically $2 million and above in revenue. And I would say we have a San Francisco office and in 2 weeks a New York office. And the comment that Ira made is very different based on coast. And frankly, even the East Coast versus the West Coast, it's very different. But the Midwest, we like to call it the alphabet soup because you got the A's, the B's, the C's, and the D's. And the Midwest, you have no idea what you're walking into when you meet a company, no matter what the revenue is, because people just gut it out, frankly. But B's to C's to D's are really just, frankly, when you run out of capital. So there's not really some threshold that says once you reach this point, then it's a C or a D. It's just you ran out of money and you need to go to the next level. But typically, a B round is typically in the range of 5 to 10 million. A C round typically is 5 to 15 million. And D rounds and beyond are typically either pre-IPO or the like, or some big event that you're trying to give some liquidity to founders. So typically it ends up being something that's been around for 5, 10, 15 years, and you want to give some liquidity to the early investors or the founders because this needs to continue going.
So that helps you frame out the structure or the steps you take in the funding rounds. And so one of the things, those series are what many times investors refer to as price rounds. So what they are doing is putting a price on your company, a valuation on your company, and being able to divide that among shareholders, and they have a price to that equity that they own. One of the things that is very often happening in the market is a thing called a convertible note. And convertible notes pop up in a lot of different places. But many times we see convertible notes, and where we're going to focus on convertible notes tonight, is when you are starting to get traction and you're not ready for a Series A per se, and you decide that you don't want to price your round, meaning you don't want to go and have a priced round. You want to have an avenue to raise money, but it's going to be evolving. And so, Ira, I'm going to hand a convertible note over to you, and maybe you can provide a little bit more details, and then after that I'll ask a couple of the panelists for their insights on what we've discussed so far.
Sure. So I'll talk about convertible notes in a second, but tie in one of the big questions at every stage with every company is the valuation, and what is an appropriate valuation for a company. And that's something that an entrepreneur and an investor may tussle about and argue about. But convertible notes historically generally are actually used to help bridge a company from one financing round to the next financing round. That is typically how you would have seen convertible notes used. Over the last 5 to 7 years, many people have used them actually at that first stage. And part of the reason they're used is there's a speed that they can be used. If you have a convertible note, a debt instrument, you don't have to negotiate over what does the board look like, what are all the rights that equity holders have. So you can very quickly do a financing and kind of push off a lot of these, some of the more trickier negotiations until the next round. And so then the other feature that you'll see with convertible notes is often what is the price at which, what's the value at which the company ends up converting that note into the next financing round. So that's typically what you'll see, a cap of, say, 4 million, 3 million, 5 million, 8 million, whatever it is. That will be the highest price at which something would convert into the next round.
Okay, so I'm going to summarize some of the things that we've talked about as you decide, and we're going to talk about if you should get capital. And the first session we did was around should I get capital. So we're building off of session 1, but we will come back to that. So how do I get money to raise, or what are the stages that I am getting money to have invested in my company? We talked about that. Talked about a price round, and then we talked about how a convertible note has been used. We're going to debate, because there's a lot of advantages and disadvantages, and there's certainly a lot of people that have strong opinions, both from the venture capital side and the entrepreneur side about them. We'll talk about that later, but I just want to kind of frame up our general discussion around that. So before I move on to the next topic, I don't want to allow me to not ask the panelists, is there anything that you think that we should add that we didn't cover in those first few items?
I think the first stage valuation is a question that everyone struggles with, and we got really great advice from some of our early angels, and that was, before you come to any of us, go talk to people who aren't going to invest in you and ask them what they would value a company like yours, and get several people's opinion, and then come back to us, and we'll give you our opinion, and we'll find a number that works. And that was like really a fantastic way for us to do valuations.
Yeah, I think that, a great point. I think that, so valuation, you've heard a couple of times, and so those that are novices, that are entrepreneurs, when you're raising money, many times that is the first thing you'll learn about. My company is worth, I'm going to say $10 million because it's a nice round number. If you get 10 million out of the gate, you're in great shape. But we're going to say 10 million. And so my valuation for my company, for the work and the traction we have in the market, is 10 million. I go to investor X, Y, or Z, and they say, we are willing to give you $10 million. So now your company is worth your pre-money valuation of 10 million, plus the money they're bringing in, which is 10 million. So now you have a valuation of 20 million. You own 50, they own 50. It always works that simply. But that's where valuation becomes, because it's a percentage of ownership, and that's usually the biggest issue that people start with. But I will give you, write in your notes, write this down, you need to understand many of the details that we're going to talk about, because a strong valuation may put you in a position that after multiple financing rounds, if you don't have some of the other terms right, won't matter. So that is kind of the teaser. If I was doing a talk show and went to commercial, it would lead to that. Okay, so thank you, Desiree. That was a great introduction. And so maybe I'll go right back to you and say, so as an entrepreneur, you faced a decision. I could bootstrap this, or I can go and take outside capital. If you could take us through why you decided to take outside capital and talk a little bit about your funding as Get Forward grew, that would be great.
Sure. Well, I'll tell two parts of that story, and one is why we had to bootstrap, because we couldn't raise capital the first time. So we were about to launch, and I thought, oh, VCs invest in entrepreneurs, so I'll go talk to some. And we were a social venture in Chicago before really there were any social ventures, and pretty much everyone said to us, why aren't you a nonprofit? It smells like a nonprofit. This is not my game. See you later. Good luck. And so Ethan, my co-founder, and I decided we're just going to go heads down and bootstrap this as long as we have to until we take off. And maybe we'll never be fundable. That sounded like we're not fundable. So we were about 18 months old when we hit our first $1 million in transactions, like $1 million total. And we were like, okay, $1 million through our platform, like that's a real business, even though we're not making a ton of money, and most people don't put $1 million through their platform. So maybe we could apply for this incubator. And so Accelerate Labs was happening. And we decided, even if we're not fundable, at least we'll get some press if we come through it, and maybe we'll bring like, social ventures into the incubator space. So we applied, just kind of hoping that maybe we'd be considered. And the truth is, we had a really great business. And we had a really great business compared to the 280 other people that applied, and we got in. And so we kind of started from ground zero, honestly, because we've never considered ourselves fundable at that point. And as we were going through the incubator, we learned some things that we were doing really well, which was figuring out what our customers liked, getting product market fit. What we were doing really poorly was communicating what we did as a business to investors. So crowdfunding back then was a term, but people still didn't really get it. and we didn't know how to talk about it in less than 17 sentences. So going through an incubator really helped us kind of solidify that message. But even still, we went through kind of doubting ourselves, thinking we're probably not going to get funding, so let's just make the most of this PR opportunity. And we had no idea that you're supposed to go through an incubator and try to line up investors along the way, which you are supposed to do. So we got up on stage having raised like $0. We had a $25,000 convertible note from one of our biggest champions to help us hire our customer service person. And we decided, okay, we've got a lot of catching up to do because we cannot become the business we wanted to be if we don't have a tech team. Internal tech is so crucial to the growth of this business. And so we just turned it on and we just pitched a bunch of people, and actually we won over a couple of people in that big demo day pitch. One of them is here, an HBA member. And then we also got David Cohen from Techstars to invest in us. And once we got a few people believing in us, it was easy to get, easier to get more and more people on board. But we didn't have any kind of vision of our future that didn't involve raising money because we were so bootstrapped and we didn't have enough revenue being generated by the business to be able to afford the tech we needed to scale. So it was really a requisite.
Yeah, and I think one of the interesting things, and I mentioned this in the last time and I'll say it again, the game of being an entrepreneur is not about raising capital. The game is all about building your business. And what Desiree was able to do is build a business, and the capital followed. And I think that's a critical element that kind of investors will follow businesses that are being validated in the market as they scale, and getting capital to fuel growth becomes really attractive to an entrepreneur or to a venture capitalist. So, Ashish, from your perspective, when you started looking at capital, you might have had a different viewpoint. I know entrepreneurs usually look at this and how they did make the decision to raise capital in different ways. So maybe you could give us some insights on your experience.
Well, I have a similar story to Desiree. I mean, we're what I like to call sort of the 8-year-old overnight success. We started the company in 2006. So I've seen some successful companies have gone IPO with Grubhub, and we started, a few years after those guys started it. It was tough sledding. There was a handful of us that would get together for breakfasts. I mean, literally 7 of us. 3 of them have gone IPO. And we would get together and talk about the venture community. And literally it was silence. There was no venture community. And so we actually grew our business very similar to Desiree, very similar to Rishi, bootstrapped. And we ended up getting about $30,000 of run rate business. And we went out to raise capital in Chicago. And we did get a term sheet. And everyone talks about once you get to that term sheet, it's smooth sailing. We were the 1%. After we signed the term sheet, they pulled the term sheet, and I was crestfallen. I mean, it was just devastating to go through that experience. 6 months I spent after that, sort of like, we really want to do this? And Pete makes a great point. We sort of snapped out, and we're like, the victory here is not to raise capital. The victory here is to build an awesome business. And I didn't need validation to raise capital to say, we're onto something. And we just put our heads down, and we literally didn't look back for 4.5 years. And so for us, after 4.5 years, it's one of the questions people always ask is, why did you raise capital? For us, I wasn't that interested in building sort of a lifestyle business. I mean, the business we're in is, consumer internet. It's go big or go home. For us, it was, it came down to a simple equation. It's really CAC plus COGS. Is it greater or less than LTV? And what that means is the customer acquisition cost plus the cost of goods sold that we ingest as a business from a cost perspective, is it greater or less than the customer value we bring in as a business? And for us, going from sort of what we had solidified nationwide on an event footprint was sustainable, but to do that on the transient side, which is sort of the everyday parking, habitual side, wasn't going to be that way. And we said, you know what? We have some interesting options as a company, but we want to go big. And that's why we raised a round of financing with Iris Group and Hyde Venture Partners, and most recently with Such's group here at Jump Capital. And so it's been a long journey. We don't have the journey, the sexy story that people talk about. You see the Instagrams of the world and stuff like that. Those happen, but they're a data point. It's a blip. 99.9% of businesses are literally struggles to figure it out, ups and downs, and that's our story. We're still trying to finish our story.
I think those those are great insights, and I think that Rishi will give you an example of, I'm sure it was, go big or go home, but people weren't buying that story at first, or maybe they were, they just weren't giving you their money. Maybe you can give us some insights on, you talked about how you bootstrapped it, and you tried. If you can give us an insight, what were the advantages of not getting that capital? I bet you have a couple that you could share now.
So it's a rich topic, right? But to set the scene, it was 2006. It's a cold winter. So no, it was 2006. I am 19 years old. I'm in my first year of college. I had, started businesses when I was younger. I actually started trading derivatives when I was 12. Had sold a company to Best Buy by the time I graduated high school. So I had done some stuff, but not really, a company that had gone public or anything like that. So I'm a kid. And I have an idea, and the idea is to bring health information into the point of care. So putting video screens in doctors' offices to serve up education to consumers right before they have their appointment with doctors. Yes, it always sounds great to raise money. Right? Oh, great, there's investors that'll pay for this. It sounds fantastic. The issue for us became that we hadn't really validated the business when we first started. And back then, health tech, right, businesses that sell technology or tech-enabled products and services into healthcare providers, that wasn't really sexy. It was the opposite of sexy. I mean, it's still probably the opposite of sexy, but now at least it's fundable. Back then, nobody was looking to make those sorts of investments, and least of all in Chicago. And so we were told over and over again that it's not going to work. You can't sell things in the doctor's offices, in medical groups, hospitals. They don't know how to buy things. They never will. Just, not going to work. We had VCs that liked us, or so they said, and we have become good friends. And some were LPs in, and they said, hey, go build a website. We would totally fund that. We would totally fund a website. Very fundable. But this seems odd to me. And to me, just doing a website seemed odd, because we wanted to bring information where decisions were being made. Right? That was the opportunity. And in short, the reason it seemed obvious to us is, a patient that has a chronic disease, right, is going to spend hundreds of thousands of dollars on their care, ultimately millions of dollars. Their treatment will affect how long they live, their quality of life, right, the cost on our health system. And all of those decisions are generally made in 5 or so 10-minute encounters they have with their provider throughout a whole year. So if you can really bring technology in an assertive and targeted and contextual way to those interactions, you can add a lot of value. So we wanted to show up there and bring that value. And so in short, we couldn't raise money initially. Now, fast forward 2 years, it's still a cold winter. It's now 2008, and we're humming. We've got now over $1 million of revenue. First full year selling media, selling advertising. I now dropped out full time, not full time, 0 time. I dropped out, and now we're getting some term sheets. But we had tasted revenue, and we were able to fuel the business on our own, and so we were on the cusp of being insolvent almost constantly for the first 4 years. You think I'm kidding, but I'm not. I mean, there are maybe early people who saw us miss payroll. I mean, now we've got hundreds of people, and we get unsolicited term sheets for hundreds of millions of dollars constantly. But it really was not. I was gonna say, not always like that. It was the opposite of that, as far from that as possible for 3 or 4 years, and we were on the brink, but we were able to make it work. And so we got this revenue. We have 3 big Fortune 1000 customers at the time. Now there's a credit crisis, right? Hell freezes over, and our 3 big customers tell us, we love your programs, we want to renew, but I've got a budget freeze. And we of course now have 18 people or so on payroll, and so that doesn't, it's not very comforting. And so it's January, February, March. Time's going by. So we thought again about raising money, And we almost did, but resisted, and that was good. And then, after that, now fast forward another year or two, the winter's still cold. I think we got to a stage, and I will tell you, business really is about this. We got to a stage where we really validated the unit economics of our business. The point Ashish made is so insightful. I mean, that's actually what I think business is about, right? For that kind of business, but CAC plus COGS, is it less than LTV, and how much so, right? So I would call that, kind of product market fit. When do you get to a point at which you can go buy $10 for $5, right? So when you establish product market fit and you find something that you're able to sell at a profit to a certain consumer base, and now you can scale that, that's really a turning point. And there are all these rounds, but frankly, outside of life science and certain other types of companies, businesses are much cheaper to start and run and grow now. So really, there's two types of rounds. There's venture rounds and there's growth rounds. And when you can really solve for product market fit, there's a paradigm shift in how you raise money. It's not, yes, maybe that you're running out of money, but it's really at your option to some degree. In fact, Sam Altman, who runs Y Combinator, had a couple tweets early this morning. I don't know what happened this morning to him, but they're really, really good. And he talks about how there's this fundamental shift that occurs once you solve for product market fit. Right in the beginning, it's almost better to not raise too much, keep your team small, so you can go fast and be agile and really figure out what's going to work. And then you do it, right? And then you want to go fast because you are out there buying $10 for $5, and that's a good deal, or $10 for $1. And so there is this big shift that occurs. So it's really not about fundraising, although fundraising can be helpful or necessary. It's, in my opinion, all about this, product market fit. And once you find that, right, then it just all changes. That's really what this whole startup thing's about.
And I think that, so let's just step back, because we started talking about getting funding, because that's the topic of tonight's conversation. But what I had said in the beginning is that the game is about building a business. And what Rishi was able to really explain, and we heard from the other entrepreneurs, the concept of being able to show there's value in the market that you're creating market traction, and you understand the unit economics of your business to drive it successfully, and you can explain that to your team and to investors, then you can take capital to fuel growth. And that's where, and I think you did a great job, is that you have venture that's helping you get that product market fit, and then you have growth capital that's like fuel for growth. So, but most of you in this room are not in that growth area, you're in that venture area. And so one of the things that you're trying to do is get product market fit. So we're going to switch the conversation. It is to your advantage, if you want control and equity of your business, to keep your, to not get a venture capital to invest. Because you'll get 100% control and 100% of the equity of your business. But many times you can't make that happen. So what you're going to do is start to look for a partner that you're willing to split the ownership of the business and the control of the business. So those are two things. When you get a capital partner, if you're not willing to give some of that up, then you're shopping in the wrong shop. That is something just to keep in mind. So with that conversation, Rishi, you're now on the other end, and you're looking at companies on an ongoing basis. What do you look for? What are some of the milestones? And you alluded to them, so you teased your own part here, but what are some of the things that, as these entrepreneurs are looking and they're going to come to a venture capitalist to get a funding round, what do you look at? What are some of the things that you would tell them to be aware of?
Yep. And so, the one caveat I would say is there are all sorts of different investors, right? So you have a couple of different sorts of investors up here. We don't have a venture capital fund. We don't have any limited partners. So we don't have a fund thesis or mandate, right? We're doing more family office investing. So it's, there is rigor to it, but I'll in a deprecating way say it's whatever we feel like doing that month, right? And it can vary. Funds will sometimes have tighter criteria because they've raised money to go put money to work along the lines of a strategy. So my motivation, along with my co-founder's motivation, is a little bit more personal. and it comes from a personal view, right? We think entrepreneurs actually are few and far between. It is really tough to build a business. It requires an extraordinary amount of will, right, and fortitude. It really does. No matter how early you find that product market fit, you've got all sorts of other expectations on your shoulders then. And so, one, we're looking for people that really, we think can execute over the long haul and can imagine bigger and bigger and bigger every year or two, and really have the 360-degree skill set, aptitude, passion, curiosity, ambition, and so on and so forth. There's a lot of qualities we look for, and it's at that level. It's a quality level. The second thing we look for is if they succeed, which is nothing that you can bank on, even with all those characteristics, as everybody up here is a testament to. I'm sure there's moments where we all failed. I certainly had them. Even then, right, there's no success, no guarantee, but if they are to succeed, what will they create? Is it something we care about? Right, so we initially thought health tech, ed tech, there's other things we invest in as well, but is this something that we want to sponsor? Because ultimately we're putting capital at their back, but more than capital, we're also extending to them our network and our ability to lean on things, and so on and so forth. So is this something that we really believe in and that we have conviction about, that this would benefit the world if it existed? And I don't mean that it has to fit in the strict criteria of a social venture, right? But it's got to be something that we believe in and have some conviction around. The third thing, we personally look for, and then I'll give you the business characteristics, but the third thing we look for is, is this going to be a sustainable area of engagement for us? Are we going to learn about this? Is this a topic we care about, that we can help with, that we can be active with? And we may do passive things, but we generally will look for those key criteria points. That's what got us in, right? And then lastly, maybe a macro perspective was we wanted to help build the ecosystem. There's great people like Howard here that are doing extraordinary work, but something that Trava and I felt personally is the lack of seed capital, right? It really hurt us directly. So as soon as we had the opportunity we wanted to help provide that back into the community so that we could find other entrepreneurs that were on that cusp and we could help them a little bit. So those are the macro sorts of reasons why we got into it. We also just believe as operators that this can look really complicated from the outside when you go through a formal pitch process. But in fact, it's easier to understand entrepreneur to entrepreneur and operator to operator. And we're really focused on what it is that the entrepreneur is trying to sell. So, what exactly is the product and service? What is the discrete value proposition to the discrete person? So oftentimes, right, there's lots of wrinkles. When I started, I thought, boy, this is great. We're going to do this. And, this is going to be good for Pfizer, right? Because instead of spending $1 billion in television advertising, they could put money here. What we discovered is Pfizer is not a person. Pfizer doesn't buy anything, right? You've got to have a value proposition discrete enough where somebody in some function is able to buy it, or is able to get promoted for it, is able to get, whatever it is that's going to be a catalyst for action, right? So that was a key kernel. So we'll look for those sorts of things, right? There's many of them. And so we'll try to understand what is it that this product or service is adding value for, how big is that market? And have they validated that that customer wants to buy this in a recurring way, that it's sustainably creating value. And if we can find that, and then we think we found an entrepreneur, right? So a person that can go out and execute, then we'll really go in. And if we have a hunch about it, we'll make a seed investment. We'll do something that is on the smaller side, right? It could be 25, 50, 100. This is more on a convertible note, those sorts of things. And then if it works, right? If we're correct and we're able to add some value, and we have a unique way to do that, then we'll follow on. And so that's sort of how we view this work.
So what we're going to frame it up once again is you're decided to fund, you have a partner. One of the things that I think is clear is that you have different types of groups that may fund you, and I'm going to talk about those in a second. But I think once you make the decision that you want a capital partner and a capital partner wants you and you're ready to have that relationship, relationship, they're going to look based on their criteria at your business. And what, if we went, and we're not going to spend time on this, we're going to talk about deal terms, it's going to be different. Some organizations have an investment thesis. It might be a SaaS model. Some others might be a host of different factors. But what they're looking for is the value that you're creating, the traction you have, the ability that you can scale and differentiate yourself in the market, and ultimately be able to grow into a successful business that they're going to get the return they're looking for, making them successful and you successful. So in looking at that, I'm just trying to frame that up. I think that those are important things. One thing before I get into what are the terms you look in a term sheet, I think Rishi brought a good point, is there are a lot of different type of investors. So there are friends and family, that is your mom or your dad or your uncle or your great friend that has a lot of money, that just believes in you. And that is structured in crazy ways and good ways. It all depends on who they are. The next one is an angel that is actively in the group, that has a process that they're in. They're investing their own money. Then up the stream is an angel group, like Hyde Park Angels, which is a group of investors that participates together, that invests similar to a venture capital fund, but they are member-based and they invest individual by individual. And then there's venture capital funds. And venture capitalists create a fund, they get limited partners, and those limited partners believe that those venture capitalists that they're putting their money into that fund will be able to select the right companies to invest in, and that they will win. And Rishi was talking about a family office, which is kind of a hybrid between an angel group and a venture group, is that they have, and I probably will let you describe yours if you want, because I probably will.
And ours is unusual, but usually family offices will be indirect investors in startups through investments in venture capital funds, right? Now, with some family offices where, they'll be just opportunistic direct investors, which is fairly common. So probably not a group that you ought to intentionally target for a seed type of investment. Those that are interested in seed investing will have some sort of, direct investing entity. In our case, it's Jumpstart Ventures, and then we'll be, LPs and others to the actual office.
So in that, I think we have a pretty good sense. Now, you got a business that's growing. Oh yeah, sure.
Well, I just want to add, equity crowdfunding is something that people talk about, but we haven't said where it falls into the spectrum. So
Thank you.
maybe some of our more senior investors could talk about where they are seeing it or where they like to see it. Or they don't like to see it. I can tell you as a founder where we're seeing it.
Senior meaning older?
Later stage, I'm sorry.
Yeah, I think that the points being made, it's hard one to follow Rishi in general. But the premise of investors in general, you have to think of it as signals, right? Which is, investing is very much a herd mentality. You see it in the news with Uber, you see it in the news with all these big startups that raise a ridiculous amount of money, and it really is the 0.001 percentile of all companies. It really is.
Why are you pointing at me?
No, you're not. You are the 0.001%.
There you go.
By the way. No, but the premise of signals, and the point being is that when you bring in an investor, you should wait to the last period possible. You should wait and build a partnership with them. And crowdsourcing is a way to get product market fit earlier without building a direct relationship, frankly, right? So you're able to get a whole bunch of people to invest, and it's a great way to assess whether the market wants it without really spending a lot of time. And at the same time, when you get the investment, it's really with no strings attached for the most part. When you're building a relationship with a venture firm, people get so hung up about the terms, which we'll talk about in a second. They get hung up on valuation. We would tell you that this is like marriage, except in marriage you can get a divorce. When you take investment from a partner, we're together till the end. And so it really is important to find the right partner than to make sure that you get some specific valuation you want. And so crowdsourcing, I think, is a fantastic way to get that product market fit without the strings attached and not having the commitment, so to speak. And at the end of the day, get some capital to help you actually figure out your business along the way. And usually you get it earlier on, obviously.
Yeah, I think we're mostly seeing it for our peer companies as an alternative to friends and family money. And there's a lot of reasons for that. Friends and family money comes with a lot of strings, right? It comes with family holidays. So just
I think these comments are both, right on. And I'll add one more thing, slightly related. When you do take on true institutional capital, it really is a marriage. It's going to be an involved relationship. They might be on your board, or in some way they'll be engaged. And it's really best to begin those relationships months before you're going to need to raise the capital. I know that sounds strange, right? But I think if you talk to entrepreneurs that have had very good experiences with their investors, they'll usually talk about that. They'll know a bunch of the investors that they'll then put into a process and say, okay, I'm thinking about raising capital, here's what we're going to do. They'll be decisive about it. But they'll know some of these partners and these firms before that, and it's a great way to get to know somebody. Imagine how awkward it would be if you were like, hey, I'm looking to get married in the next 3 months. You want to go on a first date, right? That's kind of bizarre to take that, that's usually how this happens, right? It's a lot easier to have a low-pressure conversation with a partner at a venture firm where they can get to know your business, you can get to know them, you can ask them about their involvement in other businesses, you can triangulate with entrepreneurs about whether the styles are going to be a good fit. And so, that's a deep transaction, right? It's going to be one that they can be on your board for 3, 4, 5 years from now, even when you're raising different sorts of capital if it works out. Whereas if you're on AngelList or you're meeting entrepreneurs in this way and sticking them into a node, it's really more transactional, right? Those are quick. You're going to send them an update, but it's not going to be as deep.
I think the relationship, we could do a whole panel on it. Oh, we actually did. It was the last one, and I encourage you to go online, and we have it online, because this is so rich, and we could talk a lot about how important it is, because I think that marriage is an example, but I think it's even greater than marriage if you're building a successful business. So there's a lot of people involved. So in that, we could spend a lot of time, and I think all points are very valid. Desiree, crowdsourcing is an excellent option. Thank you for adding that in. It's often forgotten, but it's a real option that people are exploring. So let's assume you got a growing business, you got good traction, you decided that you want to get married, and that you're going to get a capital partner. And they like you and you like them, kumbaya. So now it's time to say, what is this going to look like? And usually the way you start to do that is you put together a thing called a term sheet. So Saj, since I started with Ira before, I'll start with you. What would you say are the, I'm going to throw 5, you can say 3 or 7 or whatever, but what do you think the key points of the term sheet in a simple level that people should be aware of?
So just odd numbers, 3, 5.
3, 5, yeah, exactly. I think there's some book that tells you that's what you're supposed to do, so I'm going with it.
Right, and so just to make sure we're talking the same language, this is not convertible notes. This is just when you're doing a priced equity round. The advice I give most entrepreneurs is that there are standard venture terms out there. It's called an NVCA. So you can look it up online, you can download their templates, and my recommendation always is, if a venture firm or an investor wants you to deviate from those terms, they have to justify it. Those are standard terms that are out there. They tend to be, I would say uniformly used. Would you agree, or for the most part? There's a lot of options.
But remember, they are created by the National Venture Capital Association, and not by the National Entrepreneur Association.
Fair enough. But used, I would say, in more than the majority of all deals. So when deals come to, at least in the later stages, to where I invest primarily, they absolutely have essentially those terms, or they will after we invest. And so it just makes the process clean. I would say that terms, when you look at the different terms, there's a couple of key ones that I'll highlight. One is participating preferred versus preferred. And this is a complex structure.
Is this before valuation?
Well, I skipped valuation because I assumed people know that valuations are essentially it's more art than science, right? At early stages, it really is, what do you think the opportunity is? What do you think you've created? And who are the people behind it? But to say it's worth 3 versus 5 versus 10 versus 50, for the most part, there's no metrics behind it early on. And then later on, the more you make revenue, the more you're justified by metrics, which has a perverse incentive, I know. But the premise of valuation really is subjective. Number 1 for me, 1B, if you will, is preferred, participating preferred versus just preferred. Most investors will invest with a preferred instrument, which means that you're sitting on top, meaning if You sell the company, you get your money back first, or you convert into the same instrument. So meaning if you put in 10 bucks, I get my 10 bucks back, or we all share equally. That's a preferred instrument. Participating preferred means I get my 10 bucks and then we split it, accordingly. So if I own 10% of the company, I get 10 bucks and I get 10 bucks if we sell for, 100 bucks, obviously. So that's number one. Is that
So let me frame up a couple of things that would be, because I think when you start talking about participating preferred, it's really important. But what I'm going to frame up just a little bit, and you guys can fill in, is that when you're looking at a term sheet, what you're doing is what's the valuation, because that's what you start, that's a core element of who owns what. And then once you say who owns what, you start to say who has a preference of owning it. And that's what participating preferred is alluding to. The next big element is control. So control becomes who is controlling your board, who is controlling the right to sell, who is controlling the right to other people to determine that. So like if I just go two, it's my fault because I gave you 3 and I'm giving 2, but look at valuation and control as a framework, and that's where the split becomes where you participate.
Yeah, I would agree with that kind of demarcation. There are kind of financial economic terms, and then there are control terms. And so there's a bunch of different things that can go into the financial terms. There's valuation. There is what the equity structure is it participating, non-participating? And then there's a bunch of things that can go into the control side, which is, do I have a board of directors? Do I have a board of directors that is going to be independent? Or do I have a board of directors that really I as the entrepreneur can still control? And in some ways, there also then is a trade-off between how independent is the board, and then there's a whole list of other things that are really scary for entrepreneurs that are like, here's like 15 things that you need to go to someone to get approval for. And the trade-off we often see is the more independent the board is, the fewer things you need to go to someone to try to get approval of. And if you really want to still control the board, then an investor is going to say, well, okay, you control the board, but like, here's a list of things that, if you're going to do X, Y, or Z, I want you to come to me. And so that's kind of those are the different buckets that I put it in.
So Satch, we'll swing it back to you, and you can highlight that point a little bit further, or additional points that you might be thinking of.
Sure. No, I think that was a good framework. I probably skipped over for me, the obvious, which obviously this is not intended to be. So from evaluation, I think we covered that to some extent. For me, one of the big things that I would focus on and sitting on the other side of the table is certainly the consent rights, which is back to control. So typically when you're taking a minority investment, when somebody's coming in just investing, say, less than 50%, they're not going to typically control the board in the truest sense. So let's just assume there's a 3-person board, the entrepreneur, maybe an independent, and now this new investor. There's 3 people there. There's really intended to be an equitable kind of decision making. But as an investor, you have to remember that investors, especially institutionals, are not there day to day. So what ends up happening is that I, as an investor, trust you to do the right thing, but there's certain major decisions I need to make sure that I'm involved, at least in that conversation. And so this is like a lot of laws that are passed in Chicago, Illinois, US, etc., which is at some point somebody did something wrong. And so then people start making sure they protect themselves. And this is an area where it's called consent rights. And again, we would say that there's typically 6, 7 different things that we see typically. There could be more to be very detailed, but it could be less. But again, those consent rights are really important because they may or may not have board control as an investor, but they still may have the control over major decisions, which I think is really important. And then okay, it's yours. Yeah, and then the last point I was going to make when it comes to the term sheet, again, I'm a big fan of just making sure you spend a lot of time, whether it's over a period of time, dinner, drinks, whatever the way to get to know the person. But a lot of the things that you'll see in the term sheet really are intended to be the legal binding contract. And again, to use that horrible marital kind of analogy, it's the prenup, right? You should never, ever look at the document ever again, if you have a good relationship, frankly. It should be, you're having great dialogue, you're communicating regularly, and you're moving forward. So when you look at the term sheet, you can get really hung up and the relationship can get really strained when you start focusing on specific topics, but really focus on the relationship part of it versus those two key sections, which are financial and control rights.
So one of the things is understanding the big blocks, and we're going to talk about, one of the things is you started, and I really encourage you to utilize the resources through a variety of different sources. Hyde Park Angels is putting a blog and a newsletter about Brad Feld. There's a host of others. Familiarize with this because these terms are going to be your equity and your control. And so you're going to definitely, the more you know, the better decisions you're going to make, but you're going to need legal counsel clearly. So it's understanding what to ask and how to work with your legal counsel. So we have the venture capitalists kind of provide a good perspective of what's important to them. And honestly, we could spend 3 sessions on this. But I'm going to swing it over to the entrepreneurs, and I'm going to start with Ashish. And you can say, what would you say are, when you're looking at things that are important to you as an entrepreneur, what would you say, hey, group out here, these are the things you should make sure you're looking at?
Yeah, so for me, it is complex, and there's a lot of resources out there. But the way I look at it as an entrepreneur is think of it as a 3-legged stool. And I think these 3 things are the most important things, at least that I value. Valuation, of course, liquidation preference, and the third one being board structure. And they all sort of revolve around a lot of different elements that these guys have talked about, provisional controls and things like that, especially on the board structure side. The valuation is obvious, but you can't, just like if you knock one leg out, the stool falls down. And so I see a lot of entrepreneurs, and I've been naive enough to look at this myself, especially that first term sheet that got pulled, was valuation was great. However, what I didn't realize was, and I actually had a mentor, Dick Costello, many of you guys know, who ran Twitter, before he moved out to the Bay Area, he reviewed my term sheet. I mean, what better talk about mentor. And he told me these words: run away. Those were the words he told me on that first term sheet I got. Because the board structure was misaligned. Basically said in the board structure that I'm giving up control of my company. It would have been two board seats to them and 1 board seat to me. I mean, yes, you look at it, and it sounds like it's so obvious. Who would ever do that? But when you just spend a lot of your time and energy, and you got this valuation, that's the first thing most entrepreneurs, whether you're savvy or otherwise, the emotion of that is so strong that that's what most people obsess about. But I go back to sort of that 3-legged stool. It's a balance between valuation and liquidation preference, which these guys talked about, which this is where you can get crushed as an entrepreneur. Most of the time, you're going to be common stock, right? And so if you take money from these gentlemen here, their preference, okay? So if you take venture capital, you are trying to sell your company eventually or go public.
So I'm going to add just in the preference. So everybody understands there is equity, and in that equity, everybody who has given money, remember that 10 million, I got pre-money valuation 10 million, and they came in and they put 10 million of hard cash into it. Now I got 20 million. My 10 million, 50% is going to be in common. Their 50% is going to be in preferred A or preference. I think that might be helpful for the group. And that is the simplest way to think of it, but that's when you're talking about preference. And then when we go sell the company, preference gets their money first. If it's for 100 million, kumbaya. If it's for 24 million, things start to change. So those are the things that are why preference of who has the preference of getting the money first might be a good way to think about it.
Yeah, that's exactly right. And so to me, preference is so important because so many entrepreneurs get these rich valuations, but they're buried. For them to ever see a penny, you have to overcome sort of a hurdle, some threshold number what Pete just talked about, whether it's 2,400, whatever it might be. It depends on how much you've raised, and it depends on what you've negotiated in terms of a liquidation and liquidation preference, non-participating preferred. It gets really complex, but the point is if you're going to go out and raise venture capital, to me those are the 3. There's a lot of points, but those are the 3 primary points, and the board structure is extremely important. And when you're looking at a board, you got to like the people. You really got to like the people. Shit hits the fan, and it inevitably does. Every business, good, bad, so shit will hit the fan. You want them standing next to you. You want them to support you in good times and in bad times, especially in the bad times.
This is live streamed, by the way.
Yeah, but I think World Wide Web, you get anything goes. And if Howard was here, he'd probably be loving it.
Yeah,
So,
it's not gonna be bleeped out.
that's great. I'd love to get your input.
Yeah, I want to give a slightly different perspective on your first term sheets. I also got a first term sheet where David Cohen was like, run, that's horrible, it's scary, go. We had no other term sheets coming. We were kind of hoping we'd wake up Christmas morning and have that term sheet, but that's not how it works for a lot of people. You might get, pockets of investors that are interested, but they're all about to give the same amount of money. It's $25,000 or $50,000, and no one wants to lead because it's an angel round. It's, leading a round is a lot of work. They have to go through their lawyers, and so you as the entrepreneur are kind of wondering, what am I going to do? I have people saying yes, but no one wants to lead this round. And a friend of ours told us that actually there's a way for you to do this where you lead the round. And so what we did was we took, Techstars has a documents database where you can go get a founder-friendly term sheet. And we took that founder-friendly term sheet to our 3 most seasoned angel investors and said, and actually, one of them was a VC, and said, what do you think of these terms? Would you sign off on this, given the valuation that we'd already circled? And they said, yeah. And so once we got 3 people to sign off, then we were able to go get more people. And it was a lot easier way to kind of, put the stakes in our corner. And we also were able to negotiate things that aren't typically in the term sheet. Like we were able to negotiate the option pool happening after the round, which I know is atypical for us. We never were able to do that again. It was just a one-time.
That's impossible, generally impossible.
It is. But we got really lucky that first time. So I think that's one thing to consider. And then another thing to consider is that a board, you should keep as small as possible for as long as possible. And that doesn't mean that there's only 3 people in the room. It just means there are 3 people with voting rights in the room. So once we raised our Series A, or it was kind of a bigger seed stage truly, we only had 3 board members, and it was me, my co-founder, and our lead investor. But we had 2 silent chairs or observing board members. And they were very vocal in the meetings, but they weren't able to vote. And what that gave us was another perspective in the room, because I think often VCs or angels don't want to be the only outside voice. So they want that second outside board member, but you can kind of compensate for that if you bring in the observing chairs. So just something to consider.
That's excellent. I think that, what were the 3 Fs? Founder-friendly term sheet. Fun sheet, yeah.
Or
There we
term
go.
sheet, yeah.
You should trademark that. Rishi,
I meant to say term sheet. I don't know if I said fun sheet, but whatever.
I think you said
all right.
Comment on one of the things that Desiree is pointing out. The first round is a really difficult round in general for entrepreneurs. That is the round where no one's invested in your company yet. You need to prove to someone, you need enough evidence that people are willing to invest for one reason or another. And that actually tends to be around, we invest in these rounds all the time, it tends to be around that investors who are institutional investors are happy to write a little check for it, but really don't want to do any other work for it, which sounds horrible and like we're lazy, which maybe we are. But it's more for bigger rounds when we're going to take a bigger ownership stake. Those are the rounds that we end up spending time on. So for these really early rounds, it is difficult because then if you cannot get a lead investor, then you have to go around and convince everyone. And there are some cases where you'll see some of these early rounds where somebody is willing to kind of write a return sheet and lead it. And that tends to make it easier for the entrepreneur to actually go and raise the money.
So that's a good segue, because your other option is to do a convertible note. And if Troy Hennekoff was here, people have such strong, Troy Hennekoff runs Techstars and math, and he has a very strong opinion. He was on the last panel and spoke for 10 minutes about it. So go to you can view that. But maybe, Ira, you could talk about, and we'll talk about convertible notes and how that becomes in that initial stage, which you were kind of alluding to, where people aren't putting what they consider as meaningful capital into that investment, but it's allowing an entrepreneur that they think is moving an opportunity to get to a Series A or a price round. How would you?
I think that the first round, when you take in the first institutional round, a convertible note is a really good thing. I generally think, now a convertible note with a cap on the valuation. But one nice thing about a convertible note is all of these control terms and all of these things that you would have to figure out how to negotiate, you just say I'm not dealing with any of those things right now. The only thing I'm dealing with is let's write a note that it looks like a loan, but it's really equity that has a valuation to it. And look, if things go well, this will convert into the next round, and you'll kind of push off all those discussions. And in fact, the further along an entrepreneur can get the company and the more traction there is, the more, in some ways, the more power the entrepreneur has whenever that negotiation comes around. And so I generally think they're a very good thing. On the investor side, we don't want to invest in a convertible note unless there is some cap valuation on it, because we do need to know, I'm investing this much money, what percent of the company will I own if things go well? So that's my general view on convertible notes.
So I'm going to open it up to the group, and I'm just going to say convertible note, I'll describe it, it is a loan that converts into equity. And so you have to pay, there's a payment, an interest payment that will come, and then there's terms that will help protect the investor. So when you talk about convertible note, it's a debt instrument versus equity, and therefore you don't have the same things with regards to the equity perspective. So
a big piece of that is that you get a discount on the next round. And so if you have a discount and a cap, the discount can end up being immense. So just keep that in mind.
It's potentially full wrenching. So I mean, I was on my board, so I got to be very careful here. But what I would say is I actually differ from an entrepreneur's perspective. If you're going to do a convertible note, to me, there's two primary reasons why you're doing that. One, you can get the cost significantly less from a legal capital, from a legal cost. If you can get, these days you can do a Series A. There are lawyers out there that will do it for $10,000 or less, right? And that's one of the primary benefits that you have on the convertible note side, right? So there's a big reason why there. The only other reason, my personal opinion, if you're an entrepreneur to do a convertible note, is if you can do it where there's no cap. To Tyra's point, if you put a cap on that, you've effectively priced that round, all right? At which point, if you price that round, it's actually, in my opinion, worse as an entrepreneur, because the whole point of potential down the road is you don't want to have to put a value in the company. But the cap effectively puts a price on that company.
So this is actually where you get into the religious conversation, which is, if you are an investor, feels fundamentally unfair to be investing in a note for an early stage company that doesn't have some kind of valuation to it. Because what you're saying is, I'm loaning you some money that's going to earn 8% interest. Your company's really risky, and I have no idea what percent of this company I'm going to own. So that is, I think, actually where you get into this religious conversation.
So that's why I was trying to put it towards the end, because there are so many opinions, but understanding it as a vehicle, as an entrepreneur, you have had a really good real-time explanation of how people view it. Rishi, I know that you see this. I'm gonna let you comment on a few things. You've been sitting there patiently.
Up itself for a while. This convertible note issue that you're hearing us talk about has been very controversial in investor or venture circles, right? So, it's because we deal with it all day. I'm trying to think how, for all of you, it really makes a difference. And in my opinion, it's really only in two cases that you should be mindful of, but it shouldn't really drive your thinking on the matter. So one, if you raise a lot of money in a convertible note, so say you raise $500,000 in a convertible note, then 6 months or a year later you raise another $1 million in a convertible note, maybe some more money, and then you have a small A round, right? So this happened. We led an A round in a company a couple months ago. They'd raised over $2 million in a convertible note. We were putting, it was a small A round, it wasn't huge. So it was almost upside down, where there was as much converting as there was going in. And so we said, well, we'll put this much in, right, on pre-money for that much post-money. We're not gonna get diluted by money that's not coming into the round. And in principle, everybody agrees, but there's just sort of this shrug saying, well, it's ambiguous. That's Mark Seuss just wrote about this a lot. He has a blog post on it, both sides of the table, very vocal, maybe more than Troy even. And so you can read about that if you want, but it's a pretty remote case, right? So it's if you're raising a lot of money into a convertible note. If you have a $250,000 convertible note or a $500,000 price convertible note, those have been fairly conventional, will not blow this up. If you've raised millions into a convertible note, you need to address with your convertible note investors, legally with your legal counsel, how those dollars will be treated, right? So the pre will be inclusive of them, because that's going to be the expectation of any institution. The reason it's controversial now is investors with write bigger checks, are looking at this and having the same reaction, I had, which was, there's no way. We agreed to a pre-money of say 10. I'm not giving you a pre-money of 12. We agreed to 10, right? So if I'm writing 5 on 10, my post needs to be 15, not 17, right? And so that's the whole deal. Mark Schuster writes about this in a really eloquent way. And so that's not that big a deal though for all of you, in my opinion. Just be mindful that if you raise millions of dollars in convertible note, it's an issue. The second thing that is more maybe interesting to note is what's the maturity on your convertible note? If it's 2 years or 3 years, there are times where 2 years in or 3 years in, you think this is equity, you've forgotten about it, you're trying to raise your next round, and this note now will become due. And your investor can have some leverage that you didn't really anticipate in that sort of situation, because you've spent this money, you don't have $500,000, right? And now all of a sudden you've got to come up with it, or you've got to work a deal out. And so that's okay in my opinion, but you just need to be aware that that's the dynamic. If you go and take equity, then it's true equity. They can't call that equity, but they're also getting certain control and they're getting other things there, and it's really oftentimes where you get a seed convertible note raised, you don't have an equity option, right? So it's a lot of brouhaha about nothing, because a lot of times people taking the early notes can't raise a equity round. There's no lead there. There's all these other issues. So those are just two perspectives to keep in mind from the entrepreneur's perspective. I think this all seems very complicated, but if I were in your shoes, I would think about it from the following lens, right? And just 3 pieces of advice. One, if you take the money, you take the term sheet, it closes, how does the money out work at different scenarios? So if you sell the company for $5 million, $10 million, $100 million, whatever are your realistic scenarios, how does that waterfall work? How does the money out work? It's a great way. It'll capture the participating preference, non-participating preference. You'll see what's relevant. It's really a fundamental question. And you can work with counsel to understand that in a way that anyone should be able to understand. So based on these scenarios, exactly what happens. So that's one good lens to view it, because it captures all of these different things that you ought to understand anyway, but it's one good way to do it. The second is, how is the ongoing operation of the business? What decisions do you need to go get approval for, and who do you need approval from? Is it the board, or is it the investor, right? And is there alignment on whether or not you're getting active investors or passive investors? There's no right or wrong answers. You may want active, you may want passive, right? But you just need to have alignment on that. And the third piece of advice I'd give is get a reputable lawyer. The only real weird times we've dealt with stuff as an investor in 40+ investments, and like a dozen that we've led, is where you get some odd lawyer who doesn't really do this for a living. They're not doing venture deals all the time. And so they're really taking this seriously or something, and they're advocating and riling you up, and you don't really know what to begin with, and then you just got all these oddball questions. And then sometimes, you get to see the temperament of the entrepreneur, right? And it can affect your decision as an investor as well. And so I would just say, get good advice. It doesn't need to be really expensive. I'm not suggesting, that you go spend $100,000 on this, but there are good ways to do that, right? I mean, you can, instead of reading the ends of the internet, or even go to panels where people may or may not know what they're talking about, read Venture Deals by Brad Bell, right? He knows what he's talking about. And get lawyers who do this really for a living, and just it'll be a lot easier. It's money and time very well spent.
I think that's a great point. So I'm going to summarize, and in the sake of making sure that we have time for questions, we were hoping to get into some more details, but even as we built this series, we wanted to talk about building the relationship in the first series. In this series, we wanted to talk about the specifics of a deal. Even in discussing the specifics, you can sense from the panelists, there's nuances to be aware of generally that are going to be important. So let me summarize those, and then I'll open it up for questions. But the idea is, do you get capital? Who do you get it from? The opportunities are friends and families, angel investors, angel groups, venture capitalists, and occasionally family offices. Deciding what you want to give up by getting venture capital to help you grow is going to be determined first through that your first stage of negotiations
in your term sheet. And in that term sheet, two of the big buckets are going to be the equity, which has all the deal with regards to preference and so forth. And then the next element is control. What a key element is understanding that you need legal counsel to help you make this decision. And one of the things that is an option as opposed to doing a price round is a convertible note. One of the things that I encourage you is that you need to understand all the things we talked about on a term sheet with a convertible note when you're dealing with it, because you're going to convert that into a term sheet. So understanding what that convertible note looks like is going to be important and how it impacts that next round. And I guarantee you your Series A investors, if that's your next round, are going to really care. So that's the summary of a lot of discussions, and you can see there's nuances that a lot of people, I'm sure, picked up details. The panel, I think, oh, and Desiree brought up the best point of the night, and I forgot it in my summary, so I should actually have some sort of form of, we'll just add it, crowdsourcing. Crowdsourcing is a new, I think, great substitute for friends and family. And there is, understanding it is important, but for tonight's purposes, it is a legitimate option that people are taking advantage of for a variety of different ways. So I would typically give a quick round of recaps in the panel, but for the time's sake, and I know that the group has said